Hello everyone, I am Krish Vijay Ramnani and today I will be presenting on company formation, corporate governance and capital market in India. These three areas together explain how companies are created, how they are controlled and how they raise funds. So let's begin with the introduction. A company in India is recognized as an artificial legal person. It has a separate legal identity from its owners, can enter contracts, own property, and can sue or be sued. All companies function under the Companies Act 2013, which provides a complete legal framework for their formation and management. Now let's move to the types of companies. There are four key types of companies. First, a public company, which can invite the general public to buy its shares and debentures. Second, private company, which restricts the transfer of shares and cannot raise money from the public. Third is the one person company or OPC, which formed by a single individual with limited liability and its own legal identity. And last and fourth is the startups, which are innovation driven enterprises designed for rapid growth. Examples include Reliance Industries as a public company, Zerodha Private Limited as a private company, Broombikes OPC Private Limited as an OPC, and Ola Electric as a fast growing startup. Once the business structure is chosen, the next step is the formation of the company. Corporate formation refers to the legal process through which a company is created under the Companies Act. This process provides legal recognition, limited liability, and continuity, which means the company can continue operating even if ownership changes. For example, Zomato was first incorporated as Zomato Private Limited before, but later becoming a listed company through its IPO. Let's now see the steps involved in forming a company. The formation process includes four main steps. First is promotion, where the business idea is identified and planned. Second is incorporation, where documents like the Memorandum of Association and Article of Association are filed with the registrar. Third is the certification of incorporation, which legally confirms that the company exists. Finally, the commencement of business allows the company to officially start operations. These steps ensures lawful existence and the ability to enter into contracts. Once a company is formed, it must follow proper governance. So let's move to corporate governance. Corporate governance is the system through which companies are directed and controlled. It defines the relationship between the board, management, and stakeholders. Good governance ensures ethical behavior, transparency, and responsible decision making. For example, the Tata Group is known for its strong and ethical corporate governance practices. Now let's look at the guiding principles. There are four major principles of corporate governance. First, transparency, which means sharing accurate and important information with stakeholders. Second, accountability, which means management and directors are answerable for their decisions. Third, fairness, which ensures equal treatment of all shareholders. Fourth, responsibility, which means following laws, ethical practices, and fulfilling obligations. These principles build investor confidence, improve company image, and support long term sustainability. Now let's move to the capital market. Capital market is where long-term funds are raised and invested through shares, debentures, and bonds. It helps companies expand, modernize, and grow while also giving investors opportunities to earn returns. The primary market deals with new securities, while the secondary market allows trading of already listed shares. For example, LIC raised 21,000 crore rupees through its IPO, while companies like Tata Motors are actively traded in the secondary market. Now let's look at how different companies raise capital. Private companies and OPCs cannot raise money from the public, so they depend on private sources. Private companies rely on methods like private placement, angel investors, and venture capital. OPCs mainly depend on the owner's own capital or bank loans. For example, Byju's Private Limited has raised more than $5.5 billion through private investor like Tiger Global. A real OPC example is Broombikes OPC Pvt Limited, which typically raises capital through the owner's personal investment or loans, as OPCs cannot issue shares publicly. Now let's see how public companies and startups raise funds differently. Public companies have a wide range of fundraising options, including IPOs, FPOs, right issues, bonus shares, and debentures. Startups, on the other hand, rely mainly on private equity, angel investors, and venture capital. For example, Zomato raised 9,375 crore rupees through its IPO in 2021. Reliance Industries raised an impressive 53,124 crore rupees through its right issues, the largest in Indian history. Startups like Ola Electric have raised over $1 billion from VC firms, and Flipkart raised $3.6 billion in one of the biggest startup funding rounds in India. To conclude, corporate formation gives companies legal identity and structure. Corporate governance ensures ethical and responsible functioning, and the capital market provides essential long term funds for growth. By analyzing real companies and how they raise capital, we can clearly see how legal and financial systems work together in the real world. Thank you.